The strategies and concepts discussed are for educational purposes only and do not represent specific investment, tax, or estate planning advice. Investing carries an inherent element of risk, and it is in everyone's best interest to consult tax, legal, or an investment professional. John Cyndia is an investment advisor representative of, and advisory services are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. Life Stages Advisory, Dean, and Remington are not affiliated with USA Financial Securities. Welcome to episode 49 of WTF, Wealth, Taxes, and Finances. I'm your host, John Cyndia, certified public accountant, personal financial specialist. Last episode, we talked about business plans and setting those up. Now that you've got your business running, guess what? We're going to be in the middle of tax season, like right now. So what I want to do is go over some of the things from 2020 that hopefully aren't going to sneak up and bite you in the butt here during tax season, but there are a lot of people out there that have some misconceptions about certain things that either were or were not going to be taxable, what they have to report and what they don't. So we're going to clarify some of those, and then we got Remington and Dean in today.
Hello.
What's going on? Oh, suspense.
They have to be so damn dramatic all the time.
On the edge of their seat here.
Anyway, a couple of things. The
almost made me say that.
What?
My boss used to say it all the time. He's like, you paid for the whole seat, but you're only going to need the edge.
So, yes. So you are listening from the edge of your seat this whole episode, hopefully. Anyway, the first thing is the $600 unemployment benefits that were paid to a lot of people out there. A lot of people thought that those were going to be non-taxable.
Free money.
Yeah, and it's not. You know, it's like it was going to be there to help you, but it was also supplementing, in some cases more than supplementing, individuals' unemployment from their state, and actually elevated them to an income for that period of time that was severely higher than what they were making when they were working. So consequently, they did not want to go back to work and took the benefit for as long as they could. Now, the unfortunate part is, yes, that $600 as normal unemployment from the state is potentially taxable. So that's going to be something that's reportable on that tax return. And being so much of an amount, it's going to be a significant difference in the tax return. And if no one took a withholding on that, then you're going to have to come up with some dollars here. I would think that we may end up having another amount of unemployment if things still linger on into 2021 here. But what I would suggest is to take a portion of that and at least have some withholding from that if you can possibly afford it at all, rather than coming back at the beginning of the year and getting surprised at tax season. The other thing is that the stimulus payments, the $1,200, the stimulus payments are not taxable, but you should have, and you're going to have to go back and look for this form. It was Form 1444. It will say if you got $1,200, $2,400, some other amount, if you had kids, what that would be. That will have to be reported on the tax return because it was almost like an advance from a refund or a credit that you would get from the tax return. Not sure exactly how they're going to show it yet. We haven't gotten our software up and running totally, but there's going to be an offset that you will not get taxed on, but it does have to be reported. So you want to make sure that you find that Form 1444 and utilize that for and to get that in for your tax preparer when you have that. Some of the other things, the PPP loans and the EIDL loans that were for business purposes. There were several different levels of those, and they were out initially as loans that could be turned into grants. if the original participation was 75% were used on salaries, the other 25% was for rents, interest, and utilities. Then they ended up amending that to where it was 60% would be have to be utilized on payroll, and the other 40% utilized on interest, interest, rents, and utilities. So if you had gotten something in April, it was for an 8-week period of time. Then they changed that, and if it was after June, then it was going to go 24 weeks. Well, there's several calculations out there that have to be done. It's going to extend some of the calculations we have to do for the tax returns also, but there could possibly be the majority of that, of those loans should be non-taxable, and they also should not have to be paid back. But depending on how they were spent and what parts of the PPP loan or EIDL you received could end up having to be paid back. So it's worth everybody's interest to keep good detailed records and bring those in during tax time, because with the 24-week process, you had several months after the end of that, I believe it was 6 months, that you could have that reported. So it's going to sort of slide in here into tax season. So I'd say between February and May of 2021 here is when the final determination of the reporting will have to be included. And we'll see they've changed their minds on having short forms and then eliminating some altogether and what have you. But where we'll be at this point in time is to bring that in and have your tax preparer look at that. But it could be significant. We did some preliminary work at the end of last year on some clients, and we switched them from the 8-week to the 24-week because under 8-week they were going to owe about $19,000, and under the 24-week they didn't owe anything. So it's in your best interest to have someone assist you with those calculations, because they are detailed, and it is quite a pain due to having to walk your way through all of the legislation and making sure that the financial amounts and the payroll and the times and the comparisons and everything line up properly. Going forward for this year, what I would also do is make sure that you change your W-4s again. Adjust your withholding currently. Do some estimates. Once you find out if you're going to owe money or get a refund from this past year, then you can make some adjustments on your W-4 for what you'll have to do for 2021, and making sure that if you normally get a refund and you got less of a refund, you can adjust it accordingly, however makes you feel comfortable. If someone ends up owing a lot of money, you're going to have to adjust that to make sure that you've got a little bit more withholding coming out of that. The other thing is also on that PPP loan, what I wanted to emphasize also is that even though, say you didn't have to pay anything back, say you got $50,000, several businesses got, I think the average was like somewhere between $80,000 to $110,000 for an average size small business. Say you got $50,000. You received the money. It's not going to be taxable. You also spent everything on rent and payroll and, say, utilities and interest or whatever. You spent the whole entire amount. Normally, that would be an expense. Well, since it's not going to be deemed as income, it's also not going to be deemed as an expense. So people think it's not going to really have that much of an effect. What you have to understand, though, is if you were not hurt from an income perspective and still maintained normal income levels, that is the equivalent of $50,000 dropping to your bottom line. So I think a lot of people are going to be surprised that even whether it's $20,000, $40,000, $50,000, $100,000, $150,000, And they've spent that properly to where it ate up all of the expenses that it was deemed for, that you're going to pretty much have that amount of those loans and grants drop to your bottom line. It's going to have a significant tax effect that I think a lot of people are going to be surprised by. So make sure that you sit down, you go through that properly, and take your time, because there is going to be some surprises out there, I think, with that. And my staff and I have been talking about that for several weeks, and try to get the word out to most of the clients and stuff that if they got anything, that they had better increase their estimated payments for the end of that year. As far as anything else on the tax side, do you guys have any questions that could reflect on you for this year?
Well, question I have for you is I've always just had somebody else do my taxes, whether it's my girlfriend just does, because we did last year, I think we did the like TurboTax or one of those sites. Would it be better to like go to someone like you, or try and do it myself, or like, what's your take on that? Like, because I don't make a ton of money. Like if I had some crazy like successful business, it'd probably make sense to have like a professional person I could talk to directly. But someone like me, is it more beneficial just to do like TurboTax or something like that?
If it's just that you have, say, a simple W-2, and there's either one or two of you, and you're both going to be filing separately, right?
Yeah.
I mean, single. From that, if it's just W-2s, I would say that you could probably do it on TurboTax and not have too much issue with it.
That's what we usually do.
Yeah, you can save some money, I guess. From that standpoint. If you've got something else like a small business or whatever, then it's probably better to make sure that you've got someone else doing it or helping you with it, because you can get significant. We usually find that someone that's done TurboTax and has had a business or rental property or something like that, and they've done it several years for themselves, as soon as they come in to us, we can go back at least 1 or 2 years that we've been able to find stuff. And even though we bill for that, it's been more than enough to offset the cost of what we're charging because of what they missed in deductions or anything from that standpoint. So I would think if it gets past a simple W-2 or anything like that, then obviously I'm a little bit biased from it. But, we don't want to, we don't just to charge. But,
right.
It's a situation that if we can help you, we will. And if we can't, we'll let you know.
That's kind of what I was figuring. I just want to double check.
Yeah, because we've had some clients that we've had for years, and then whenever they stop working or because of retirement or whatever, we've gotten to the point of just saying, hey, there's no reason for you to even come in here and file anymore. And it was, several $100s for the returns before. And it's like, I'm not going to do it just to file it. I, tell them what, what's happening here or whatever. Or we'd make adjustments that a lot of people would end up having money taken out of their pension plans. And the only reason we filed was to get the refund. Well, it got to the point where it's like, if you're not going to be doing any of the other activities that you had, like rental properties or anything else, and that's all it is, don't withhold anything. I just adjusted my mom's because they've gotten to the point now where, they don't have that with the standard deductions and everything else. There's not any need for them to have. They were doing withholding amounts before just because they wanted to get the check amounts. Well, they're not doing as much traveling anymore, so there's no need for that.
Gotcha.
So I eliminated any of the withholding, and now we really don't have to deal with filing anything. But Mr.
1,000-mile stare down here.
Yes, that's it.
Something like
Mr.
that.
Dean.
Something like that.
He's got a question.
I don't know. I guess we could be sort of specific, sort of general. Just tell me more about write-offs and kind of just how they work. Like, what
Yeah,
can
it's
I
from a
something I've
small
kind of
business?
wondered,
From a
like-
small business?
No,
Yeah.
not even just like an individual.
Yeah, because I feel like I always hear about people with like crazy. I hope this is okay to say, like crazy workarounds and loopholes, I guess, when they do.
I
their own
write off my
taxes.
internet bill because I work
Yeah.
from home.
Yeah, stuff like that, where it's like anything helps to save or get some extra money.
$10.
Yeah, stuff like that.
I had an insurance agent years ago that he asked me if he could write off his grocery bill. And I said, why? He says, because I'm always thinking about my clients when I'm eating dinner. That was a big fat no.
That's not gonna work.
We
but
never
if
did
it
his taxes after that again either, because we don't deal with that. In the last year or so, with the huge increase with the standard deductions, we went from having about 60 to 70% itemized tax returns. So we did itemized deductions on the tax returns, and it pretty much did a whole flip. We're probably doing around 30% itemized, and about 65, 70% are just standard deductions. The thing is that while we may still do, it's not an itemized return, it's a detailed return because they have rental properties. They've got small business. So they're still complex. They just don't have they don't have enough interest. They don't on their house because rates have dropped so significantly. If they refinanced, they've normally had $8,000, $10,000, $12,000, $14,000. Now they're down to $6,000, $7,000, and $8,000. The real estate taxes have been capped with the state limitations and everything. So now you've got $10,000, and within that, you have to have your local that we have for cities here in Ohio. You have your state that you have in any of the taxable states, and then you got your real estate taxes. Well, in a place like, say, New Jersey, New York, California, some of the other places on the East Coast, if you've got $250,000 to $400,000 property, you're looking at anywhere from an $8,000 to $10,000, $12,000, $14,000 or more real estate tax bill. Well, if you've got $12,000, you can only write 10 of that off. So now you can't do your city or your state. So you're limited right there. Okay. So that's putting a limitation on it. So if you've got that is 10,000, you've got 6,000 of interest and maybe a couple $1,000s of donations for, say, the church or whatever, you're still $4,000 or $5,000 short just to get over the standard deduction. So until you get to that first dollar. So for the most part, people are with $24,000 to $25,000. If they're over 65, they've got another credit on top of that. So you're looking at over $25,000, almost $26,000 that they have to get up and over before they can itemize. So what we've been finding is, unfortunately, the older people that have are in nursing homes are the ones that we're itemizing, because if they don't have long-term care, they have to go out of pocket. So majority of those are for acute care in a nursing home, and they are eligible for deductions for medical expenses. So even though they may have significant dividend and interest income and pension, we can offset and get a lot of that reduced or even eliminated from a tax standpoint. So on a personal level, that's what happens there. If somebody's running a rental property or whatever, you're going to get your normal depreciation, the interest off of that. That's not limited because it's on a Schedule E for rental. But you'll get your normal, insurances or anything to run that particular rental property. That'll all get deducted. If you're running a business, you guys are doing the production here and everything else for this podcast. You bought, different equipment
Like
as far as
cameras,
cameras,
yeah.
lighting, things like that. So, what I'm paying you for the podcast, in order to produce that, you can turn around then and run a Schedule C proprietor business right off of that, and write off the equipment and lighting and your travel to here, running out of the house and everything. So there's significant benefits from that you'll be able to have, and then utilize that on your own. So the benefit is you've got the other cameras and everything, and you've been able to earn some income, but you can also take these deductions off of that too. So there again, you might have a rental property, you might have a small Schedule C business or whatever. Some of the other retired individuals have a lot of Schedule D or capital gains. Maybe they got a lot of stocks. They've got interest, dividends, stock sales, whatever. We've got some clients that have 100, 200 transactions a year on that. So it's still a very detailed return, but yet they are not going to itemize. So if that makes any sense.
Yeah.
So I think, some of the other items that are going to be in with the new administration, they're looking at still streamlining some other things. They're going to increase some of the tax brackets. For the most part, they will be the same. Top tax bracket might go up a little bit. But they're also looking to do away with capital gains tax set at 15%, which it has been for a long time, looking to have that go up to 39.6. So now it's going to be treated as ordinary income. So we may have some different planning attributes that we may have to be looking at, once the new tax laws, if there's going to be any that change. So we've got a lot of latitude, but then we've got a lot of things that we're going to have to concentrate on. So this is going to be a strange year. Last year was different. This year is even going to be more different because of what's happened in it and everything else. There's been so many different things that happened. We had with the COVID, benefits and everything, and then with the CARES Act and everything else that came through. So there's going to be a lot of different things coming in. Talk to your tax preparer, your individual advisor, whoever you have. And if you need any other information, contact us here at J. Cindy at Life Stages Advisory. We'll try and help you however we can from that aspect. And again, any input you may have or any ideas you'd like to have for topics going forward, we're working on a lot of new things and go to the YouTube channel. Yep. What's that, under WTF?
Look up Wealth, Taxes, and Finances with John Cyndia. It's the best way to find it.
All right, we'll do that. Dean, you have anything else to?
Nope. No, I don't. Nothing else.
Okay. Well, listen, thanks again for tuning in. We'll be in touch. And until next time is our 50th. Will be our 50th episode.
We'll have to do a giveaway.
So we have to do something
special.
We'll do something special.
Make some T-shirts.
So, well, yeah, we're going to do something, and we'll have that ready. So start getting ready to listen to podcast episode 50. Thank you. See you next time. Bye.
Bye.